Omicron, the next letter in the Greek alphabet, wasn't it Kasai? Why did we skip Kasai? I can't figure out why did we skip Kasai when we're naming these variants. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of November 29th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. Here we are, we're on episode 54 of my weeklies. That's right, 54 of these. We are well over a year, and I'm actually going to be stopping putting the episode number in the thumbnail. As one of my keen viewers pointed out, it might be turning people off to the weekly show because they feel like they've missed something. I do like that idea. I appreciate that idea. So instead, I'm just going to be saying the episode number in my intro. Has less meaning that way. So if you guys don't see it in the thumbnail, that's why. So last week kind of sucked. We only had 3.5 trading days, with Thursday being off for Thanksgiving, Friday being a half day. All the kids got to go home early around 1 p.m. and man, Friday was tough. So we had a little bit of a drop off, I guess, in the market. You could call it that. I think the Dow is down by 2.5%. All of the indices together, somewhere between 2 and 2.5% down, and this is on the fear of the Omicron variant of COVID. Ooh, another COVID variant. Are we sick of this yet? I sure am. I really think it's hilarious how, like, whenever the market pulls back by something like 2%, people break out all the great investor quotes. Be greedy when others are fearful. Be fearful when others are greedy. Guys, we don't need cheerleaders. We're adults. It's a 2% pullback. We're gonna be okay. So let's get into the news. It was a shorter week for trading, so I had to dig a little deeper to get to the interesting stuff. Hope I found some for you. I guess first news story, and you know, the biggest one, Dow tumbles 900 points for the worst day of the year on fears of new COVID variant. S&P 500 drops 2%. Man, this trader looks like he's just having a terrible day here. The new COVID variant found in South Africa triggered a global shift away from risk assets. The downward moves came after the WHO officials on Thursday warned of a new COVID-19 variant detected in South Africa. The new variant contains more mutations to the spike protein, the component of the virus that binds to the cells, than the highly contagious Delta variant. Because of these mutations, scientists fear it could have increased resistance to vaccines, though the WHO said further investigation is needed. On Friday, the WHO deemed the new strain a variant of concern and named it Omicron. Omicron, the next letter in the Greek alphabet, wasn't it Kasai? Why did we skip Kasai? I can't figure out why did we skip Kasai when we're naming these variants. Jokes aside, I think this was a bit of an overreaction. You saw there that people were pulling out of risk assets, but like, where do you go when interest rates are rock bottom? What are you gonna do? Put your money in a savings account at like 0.2% or something like that? I guess we have some treasuries that are up around 8% now, but other than that, I mean, I can't imagine a bunch of people are gonna be dumping into long-term treasuries, so it's probably just gonna go back into equities. Honestly, this seemed to me like a bit of an engineered drop. Suddenly 2% on something that we've seen before again and again and again. I understand this one might be more contagious than Delta variant, but come on, where else are you gonna go with your money right now? This probably just forced some paper hands to sell. Long-term buyers are going to scoop up the 2% discount, and we're just going to keep climbing higher and higher. One of the reasons I think we're going to keep climbing higher and higher is because, well, Jerome Powell has been nominated by President Biden for a second term as Fed chief. Some analysts and Powell supporters say the stock market has reacted positively to Powell's steady hand, and that his tenure has provided much-needed stability during these uncertain times. Inflation is at its highest level in 31 years. Americans are paying more for anything from gasoline to groceries, which increased by 6.1% and 1% last month compared with September, respectively, and are up nearly 50% and 5.4% since October. Many analysts and economists see Powell's renomination as a positive for the stock market. It provides continuity at a crucial time. Powell's renomination also likely means that the Fed will continue to distance itself from regulating digital assets like Bitcoin, which the central bank chief has said he would not favor restricting. All in all, I think this is a good thing. Jerome Powell comes back. The money printer is going to keep churning, which means the stock market casino is just going to keep flying up and up and up until sometime in 2022 when the Fed starts cranking up the interest rates a little bit, which will then push the stock market down and down and down. So at the very least, we've got another 6, 7, 8+ months of fun times at the slot machine. I really do like this though, because Janet Yellen was making some rather disparaging remarks about cryptocurrencies and Bitcoin, and she was quoting some outdated information about cryptocurrencies being primarily used used by thieves and counterfeiters and the criminal underworld. I mean, has she seen what the US dollar is used for? Come on. So Jerome Powell being kind of shy about regulating against any cryptocurrencies is kind of a step towards the strengthening of cryptocurrencies even further. And even though I don't talk about it often on this channel, I am a big supporter of cryptocurrencies and what they mean for decentralization. Disclaimer, heavily invested in Cardano and Icon. And we also actually got more news that's kind of tied to Jerome Powell loosely. The weekly jobless claims plunged to 199,000, which is the lowest level in more than 50 years. This is obviously amazing. The 71,000 jobs slide marks the 8th straight week of declines, a reflection of a tight labor market that has companies scrambling to retain and expand their workforces. Just since January, we could see the jobless claim numbers. We were floating up here around 800,000 at one point, and it's just been more or less a steady decline. This is really great to see week to week to week, all the way coming down. So this isn't even just a low point for COVID. This is a low point in decades. The reason that I bring this up after mentioning Powell is that Powell has been looking at these jobless claims to decide when to start increasing the interest rates. I'm thinking as this number gets lower and lower and lower, you know, we might be able to see that interest rate number come up a little bit closer from like mid to late 2022 to maybe early to mid 2022. And that could really put the brakes on any type of stock market climb, any continued rally based on what we've seen historically about the relationship between stock market equities and interest rates coming out of the Fed. Germany is going to be legalizing cannabis. The country's new coalition leaders announced as Angela Merkel's 16-year reign ends. Germany is poised to get a new coalition government after 3 leading parties published a new power-sharing agreement. Blah, blah, blah. Don't know much about German politics, but the center-left SPD, Liberal Free Democrats, and eco-friendly Greens are now poised to take power from Angela Merkel's conservative CDU party 2 months after it was given a drubbing in national elections. Publishing their agenda for government today, the so-called Traffic Light Coalition said cannabis will be regulated and sold to adults for use in licensed shops alongside a raft of other measures, such as phasing out coal power and steps to tackle COVID. Since legalizing medical marijuana in 2017, Germany's market has become the largest in Europe, selling 154 million pounds worth of high THC products to patients last year. We saw what medical marijuana did to the German economy, and now legalizing general recreational cannabis is obviously the next step in that direction. And the US markets, other than the fact that they were taking a heavy drubbing, actually showed some response to this in the market this week, with a lot of the cannabis companies, while still dropping with the wider market, they weren't dropping as much, they weren't as effective because there was some lingering positivity here. I mean, just politically, if you look at the spread here, we have a conservative leader, a conservative party, losing power to a more liberal party, a more liberal leader, and this is going to be shifting a more open stance towards marijuana and its legalization. And this is what I think a lot of people expected here in America with the Biden presidency, and we haven't gotten that yet. Personally, and once again, I know this is kind of a controversial issue, I think legalizing recreational marijuana is a good thing, simply because the government will be able to tax it and stop wasting taxpayer money fighting marijuana and incarcerating people for low amounts of possession charges. It's just a silly system, and the amount that's being wasted when it could be turned into a money-making enterprise just seems silly to me. A lot of the stocks, if you did take a look at your portfolio this week, were not hit as hard, and this is why. Moving on to Bitcoin. We touched on it a little bit earlier in the episode, but El Salvador is going to be creating a Bitcoin city using $500 million worth of its planned $1 billion bond offering to buy more crypto. El Salvador, the only country in which Bitcoin is a legal tender, is going to build an entire city based on Bitcoin. Bitcoin City will be located along the Gulf of Fonseca near a volcano. The government plans on locating a power plant by the volcano to provide energy for both the city and Bitcoin mining, the president said. Bitcoin City will be a full-fledged metropolis with residential and commercial areas, restaurants, and airport, as well as port and rail service. The city will be laid out in a circle like a coin, and in the city center will be a plaza that will host to a huge Bitcoin symbol. The city will have no income, property, capital gains, or payroll taxes. There's so much to unpack here. This obviously sounds like some magical type of crypto utopia, and I think the picture that's being painted here is way rosier than the reality is ever going to be. Now, like I said, I support cryptocurrency, I support Bitcoin, but this just seems like something straight out of a fantasy land. I do like that El Salvador is adapting to Bitcoin as a legalized tender, but I do know the transition has not been as rosy as a lot of people in cryptocurrency communities would make you believe, and this is a little bit scary. This is a little scary. I think this is something where in a decade we're going to look back at El Salvador and either it's going going to look like the smartest country in the world or the dumbest country in the world. And there's not going to be any middle ground here. None whatsoever. Now, for the commercial version of El Salvador, MicroStrategy, this is back from June. And I think I forgot to cover this, but MicroStrategy has been investing its own assets into Bitcoin. And currently it's holding about 105,085 Bitcoin, which, yeah, that's a lot considering the maximum circulating supply ever is going to be 21 million. So they're holding a significant fraction of the maximum circulating supply. MicroStrategy, like the entire country of El Salvador, this is either going to be a make or break move. From MicroStrategy's perspective, if you see any of the interviews with the CEO, he is a huge believer in Bitcoin, in cryptocurrency. Actually, he's almost like an evangelist or a televangelist for cryptocurrency. If you go to the MicroStrategy website, there's an entire tab on Bitcoin. I think it's called like Hope or something. It redirects you to a Hope website, and there's all these interviews with Andreas Antonopoulos and Bitcoin experts, crypto experts, the CEO of MicroStrategy talking about how this is the future of currency. And as somebody who's just a passive spectator on the side, this is either going to be magical in a decade or this is going to be terrible. And there's not much I could say. There's no other way to look at this. They're either going to be geniuses in El Salvador and MicroStrategy or idiots. If we look at the MicroStrategy stock price, it's kind of silly right now. PE is trading at about 100. The market cap is about 6.87 billion, and the float's really low on MicroStrategy. 8.3 million free float, 10.3 shares outstanding. Before the pandemic started, MicroStrategy was trading right around $160 a share, dropped down to a low point of 90, and then this is when they started kind of investing in Bitcoin, and the popularity of the company ended up taking off for that reason alone. At one point during the fervor in February, hitting a high of $1,315 before kind of coming back off. So we are in a bit of a wedge right now on MicroStrategy. Looks like we're at the bottom end, and the price is probably going to start bouncing back up. We could kind of draw a trend line almost right along the 200-day moving average right here. Next news story, Toyota busts the car microchip shortage. Toyota, the company who brought us just-in-time manufacturing and supply chain management, of course they would be the company to bust the microchip shortage. The little byline here, but how did Toyota do it? And I was reading through the article and I was like fervently looking for this information. How did Toyota do it? Nobody inside Toyota is revealing how the automaker has been able to secure enough chips to return to full production levels. Seriously, dude? How can you bait me with the question, how did the company do it? And then just blue ball me and say, no, nobody knows. Oh, come on. Toyota has announced it'll be back to full global production capacity in December. In fact, the company says it anticipates churning out 800,000 vehicles next month, up from the 760,000 it made in December of 2020. So they're not only going to be back to full production capacity, but they're going to be exceeding last year's production capacity. This update should have Ford, GM, Stellantis, Volkswagen, Nissan, and others absolutely seething. What is Stellantis? I don't know what that is. After all, it's been proven consumers in North America and other markets have quite the appetite for new cars. If Toyota dealerships are the only ones with any vehicle stock to speak of, and it doesn't take a genius to realize the automaker will clean up. That might even mean some shoppers switch their brand loyalty to Toyota for years to come, meaning this change might cause some long-term market shifts. To the author's credit, he does go on and talk about some statistics, some interviews from dealerships, and how the dealerships are reporting that they can't even keep cars on the lot. They're selling out of their inventory before it even gets to the lot. There's just nothing there for new car inventory, and a lot of the dealership spokesmen are saying stuff like, if we had inventory, we would be selling double of what we're selling right now. So the fact that Toyota is getting back to full production capabilities, this is a big deal. Brand loyalty in automobiles is much higher than in other consumer products, and I think this has to do with the price point. Once people find a brand they're comfortable with, they tend to buy that same brand again and again and again. If you buy a Ford, most likely you're going to buy another Ford afterward because of the experience, because of the attachment, because of the price point on the product. So if Toyota can convert some of these customers towards Toyota, pull them away from other companies, this really could be a huge deal in the future for the company. Toyota's stock, of course, since the pandemic has just been marching straight upward, albeit much more slowly than a lot of other companies by percent growth, but we are coming in at a low point of 108 on the pandemic drop, hitting a high point of 188, currently trading at about 179. Toyota does have a market cap of 249 billion, which makes it the second largest automobile maker in the world after Tesla. Sorry, Rivian, you didn't quite get here yet. I feel for you. I really do. Zoom reported their earnings this week, and as I predicted, Zoom had terrible earnings. I mean, this wasn't exactly like some Nostradamus level prediction from me. Basically, every company that was a pandemic darling is struggling right now with future prospects, and the stock market is forward looking. People really only care about the forward guidance. So yeah, I mean, this kind of makes sense. Zoom stock closed down 14% after Wall Street slashes price targets. The video chat company warned investors of a revenue slowdown. A couple of the quotes from the analysts: while we're positive on Zoom's strategic initiatives and investments in key growth areas, we find it tougher to like a stock with more sharply decelerating growth and incremental pressure on profitability. Moderating growth has been and could continue to be near-term stock headwind, though we remain positive on the long-term growth and platform opportunity, particularly as growth rate troughs over the next couple of quarters. Now, it wasn't like it was all bad. Zoom's revenue did increase 35% from a year earlier in the quarter, but this did slow from 54% growth in the quarter before. Zoom's forecasted earnings still imply a 19% growth. I think even in my video last week, I mentioned a lot of people would be probably buying puts on Zoom, and if they did, well, they probably printed, because if we take a look at the drop right after earnings here, we had the day of earnings a 3.5% drop, the next day a 14.7% drop. The day after that recovered a little less than 1%, and then we actually had a net gain on Friday as the price recovered, and people probably realized this was an overreaction. Just go back to last October, and Zoom was trading at $588 a share. Remember, this was actually right before I think the Pfizer vaccine came out. So the Pfizer vaccine was kind of the first nail in the coffin of the Zoom share price's rise. Next news story: BlackRock says it's time to buy Chinese stocks and trim Indian exposure. Because of the outperformance we've seen in India this year on a relative basis, we are starting to take profits. Full stop. I didn't know that the Indian market was doing that well, and wow, I feel like I probably missed something. I think I'm invested in Indian markets in my retirement account through one of my frontier market ETFs, but definitely probably didn't have as much exposure as I should have if India was doing that well this year. Oops, overlooked that one. Valuations are key right now. Because of the outperformance we've seen in India this year on a relative basis, we're starting to take profits and becoming more positive on Chinese growth stocks. After a world-beating rally, sentiment on Indian shares has soured due to broker downgrades and concerns about tightening liquidity, worsened by a poor showing for the nation's biggest IPO. They don't actually mention the IPO in here, but this actually just happened, I think, last week. If we go over to Wall Street Journal, this was a company called PayTM. Disappointing performance of India's largest IPO will cool sentiment a bit, but a dose of reality could make for a healthier market. India's biggest ever IPO offering was a flop. Shares of SoftBank and Berkshire Hathaway backed 197 Communications, the parent of Indian digital payments giant PayTM, fell 37% in the first 2 trading days after PayTM went public. The stock has since rebounded, but is 17% below its IPO price. First note, SoftBank cannot catch a break. It seems like everything SoftBank touches in the last couple years just turns to shit. Secondly, man, I feel like an idiot for missing this Indian thing. And, you know, BlackRock shifting from India into China isn't necessarily like a resounding call for success in China or whatnot. But if we look objectively at the valuations in China, a lot of the companies are undervalued for what they offer. But this is more so a testament to the government than the actual companies themselves. So the fact that BlackRock is just shifting money from India to China is not necessarily a huge vote of confidence in China. It's more so a vote of decreased confidence in the Indian market, saying that things are getting a little bit overvalued there and they just want to put their money somewhere with a better opportunity, a better risk reward profile. That makes sense. So don't look into this and think, oh, BlackRock's getting in, it's time to get back in China. Do it if you want, obviously, but they're just shifting money from an overvalued class to an undervalued class of assets. That's all. For the rest of the episode today, I do want to talk about a common theme, which is going to be earnings, which is going to be retail, which is going to be Black Friday, and how everything kind of ties together. And I am going to be touching on Kirkland's at the end, which was the DD video that I posted last Monday. So I'm intending for this segment to be viewed as one contiguous piece. Black Friday shopping in stores drops 28% from pre-pandemic levels as shoppers spread spending throughout the season. Initially, that sounds really bad, but actually it turns out it's not so bad. Traffic was up 47.5% compared with year-ago levels, which makes sense because stores were just straight up closed last year. here. It's clear shoppers are shopping earlier in the season just as they did last season. I've been talking about that on the channel for weeks, so this shouldn't be a surprise for any of my regular viewers. Online, retailers rang up $8.9 billion in sales on Black Friday, which is down from the record of about $9 billion spent Friday after Thanksgiving a year earlier. So online shopping is actually only down about $100 million, despite the fact that people have been spending money earlier in the season. So initially, the headline from CNBC makes it seem like this is just catastrophic with 28% reduction in foot traffic, but we actually see that the online shopping is almost as high as it was last year, which was a record year, and customers have been just spreading their money throughout the season, so retailers are still probably going to be making about the same, maybe even a little more. We did have a lot of retail earnings coming in last week, and there's a few that I really want to highlight and focus on because they're showing some trends here. The first one I want to point out is Guess. Guess is like a smaller retailer of clothes. Shares of Guess jumped more than 11% on Wednesday after announcing better than expected profit and sales for its fiscal third quarter. The retailer of apparel reported adjusted earnings of 62 cents per share, up from 58 cents per share a year ago. Revenue rose 13%, and analysts were only expecting 46 cents per share on revenue of $611 million, so they ended up beating on EPS and revenue. Now, the CEO's comment is, I think, the most telling. The better performance was driven by European wholesale, America's retail and licensing businesses, which posted strong top and bottom line results across the board. All in all, we delivered a 10% operating margin in the period, driven by strong gross margin expansion as a result of lower promotional activity and improved initial markups in spite of increased freight costs related to the supply chain disruptions experienced in the market. Strong gross margin expansion and lower promotional activity. By God, that's Kirkland's music. Now, on the flip side, Nordstrom plummeted nearly 30%, hitting a one-year low. The drop came after the luxury department store failed to meet profit expectations for the third quarter. Nordstrom earned 39 cents per share in the quarter, missing expectations of 59 cents with a big margin. Yeah, that's a pretty big miss. Quarterly revenue actually beat, but the EPS was such a loss and the forward guidance was so bad that the share price ended up tanking 30%. If we take a look at Nordstrom shares, just last week, we were trading at about $36 a share. Currently, we're coming in at about $22.56 after hours, and we could see this huge 29% drop the day after earnings. The Gap also dropped off substantially with, I think this one was about a 20% drop. And the quote from the CEO, while we entered the third quarter with growing momentum, acute supply chain headwinds affected our ability to fully meet strong customer demand. So the Gap and Nordstrom both reported supply chain headwinds that were affecting their margins and were affecting customer demand specifically, meaning the customer demand was higher than what the store was able to provide, so they ended up losing out on revenue. Whereas Guess, which is inarguably a smaller retailer than something like Nordstrom, was able to more nimbly pivot and deal with the supply chain disruptions, getting more product onto their shelves to make sure their customers had the selection, and their shares went up. So what we see is a trend of shoppers moving from store to store based on whoever has inventory, and whoever took steps to increase their inventory is getting the increased traffic. Another one that we see, Dollar Tree. Shares of Dollar Tree hit an all-time high on Wednesday. The operator of the discount variety stores earned 96 cents per share compared to $1.39 per share over the same period of 2020. Obviously, it's down from a year ago, but that was a record time. Revenue for the quarter rose 3.9% year on year. Analysts were expecting earnings of 96 cents per share on revenue of $6.41 billion. So revenue slightly beat, EPS was equal. But the guidance was pretty strong, and the CEO said, "We experienced a strong finish to the quarter as shoppers are increasingly focused on value in this inflationary environment. Our Dollar Tree pricing tests have demonstrated broad consumer acceptance of the new price point and excitement about the additional offerings and extreme value we'll be able to provide." Now, let's carry this into the upcoming earnings. This week on earnings, yes, I know there's some companies that are like tech focused that people care about, like Hewlett Packard. Do people still care about Hewlett Packard? I don't know. We'll just say Hewlett Packard. We've got CrowdStrike, Snowflake, C3 AI, Okta. These are all companies that a lot of people like, but we also have a lot of discount retailers. Five Below, Dollar General, Big Lots specifically. Now, if the Dollar Tree CEO's statements ring true, then we should see really strong earnings reports this week from Five Below, Dollar General, and Big Lots. Now, these companies were all working on getting their inventory higher before this fourth quarter because I think they sensed the opportunity coming with the inflation, with customers searching for value opportunities, which is what all of these stores do provide. If we take a look look at the Big Lots earnings call transcript from last quarter, there's a few things that I really do want to point out. Starting here, given the periods of quarantining and stimulus that impacted the business in waves last year, we're anchoring comparisons to 2019 to show underlying business trends. And this is something that a lot of retailers are doing, where they're just taking 2020, crumbling it up, throwing it out the window because it was such a weird, anomalous year. Big Lots also acknowledges the supply chain issue, with freight headwinds weighing on gross margin for the quarter. And in addition, our performance for the quarter was also impacted by labor challenges in our distribution centers. This dynamic is improving as we enter Q3, and stress on our network will be further reduced by the opening of our first 2 forward distribution centers. In addition, to alleviate immediate supply chain pressures and maintain speed to market, we've set up nimble and agile temporary distribution center bypass program for the fourth quarter that will increase the efficiency of our distribution centers and capacity to our network. Full stop. This is a huge change. This is a big risk. Big Lots changed their entire supply chain structure going into the third and fourth quarters by bypassing their distribution centers. This is going to be allowing them to get from point to point much quicker to keep the inventory on the shelves of their stores. So I think they realized the opportunity that was here with increased demand for their products in an inflationary environment. This is something that I feel like a lot of people probably overlooked on this earnings report, because monetarily, financially, it was a terrible earnings report last time from Big Lots. Something else that may have gotten overlooked, their total inventory was up 32%, which was slightly ahead of our beginning of quarter guidance. Inventories were up 8% in Q2 2019, maintaining a strong 2-year turn improvement while supporting our ability to drive third quarter performance. So their inventory was up even more this year than it was in 2019, guaranteeing that they have products for the shelves in this environment where consumers are looking to buy anywhere where there is inventory. Also, for the full year, we now expect a gross margin rate impact from freight of approximately 150 basis points, resulting in gross margin rate being down 50 basis points versus 2019 and 100 for 2020. We expect freight pressures to abate as we move forward, and we continue to see other areas of gross margin opportunity, including promotional and pricing optimization and shrink reduction. So there's a lot to unpack from this old Big Lots earnings report. And again, this was their Q2 earnings report back from August 27th. And it's very mixed, but we can see some industry trends here. We could see Big Lots trying to make a big drastic move by cutting out their distribution centers and allowing for more agile supply chain refillment. We can see a stock up of inventory in preparation for Q3, Q4, which is their big spending time of the year. And this stock up of inventory is even greater than it was in 2019. In 2019, they stocked up an additional 8%. This year, they stocked up an additional 32%. That's substantial, to say the least. We can see stores like Guess with additional inventory, with more nimble supply chains, profiting because they were able to keep their shelves full. We could see stores like Nordstrom and Gap struggling because they didn't do anything dynamic to deal with the supply chain situation, and instead just kind of blamed the failings on the supply chain costs and issues. This brings me to Kirkland's, which was the DD video that I did last week. Now, full transparency, I tweeted all this information out as soon as I saw it. The new FINRA data was released, and the short interest ratio is down now to 12 days to cover. I talked about this as being a short squeeze candidate. Short interest to float is down to 21%. It was like 24%. This was like as high as 17. So it is down a little bit. So the chance of a squeeze is going to be a little bit lower, but it's still higher than most companies, if that makes sense. But the appeal on Kirkland's wasn't just the potential for the squeeze. The appeal was how they were handling the retail situation right now. And all we can do is assume that their CEO and their CFO were not lying to us in their last earnings report when they said that they were building up their inventory, when they said that they were increasing their direct sourcing of their products, and when they said that they were cutting their ad spend, which is going to help improve their margins. This lines up with trends that we've seen just this past week for successful retail earnings in this season. As long as a store has products on shelves and the prices are competitive, and Kirkland's is very competitive for home decor compared to stores like Pier 1, Kirkland's is almost considered to be a discount home decor store compared to some of its competitors. As long as the prices are reasonable, we see the value opportunities like was reported in the Dollar Tree earnings report. And as long as the inventory is on the shelves, then we're going to see higher sales as we saw with the Guess earnings report. All in all, even though the short interest decreased, the days to cover decreased, the results of the retail earnings reports from this week made me very optimistic for the Kirkland's earnings report on Thursday. I already have my position set in, so I'm not going to be adding to it, but there you go. All right, everybody, that's it for me today. I hope you guys did enjoy the video this week. Thank you guys, as always, yous for watching the video. If you want to support the channel, please check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.